Welcome to the Deep Dive, where we explore powerful ideas designed to sharpen the way you see success, uncertainty, and human behavior. Today we're looking at a question that has probably crossed your mind in one form or another. Why do some people seem to achieve success with remarkable consistency, while others, even when they work just as hard or perhaps even harder, continue to stumble again and again? It's a fascinating puzzle, and one that feels surprisingly relatable. The answer often points away from external circumstances and towards something much deeper, an internal shift in the way a person thinks, responds, and interprets uncertainty. In this deep dive, we're stepping into the world of trading psychology, drawing extensively from Mark Douglas's groundbreaking work, Trading in the Zone. The goal isn't simply to understand trading. It's to uncover the psychological differences that separate consistently successful traders from those who remain trapped in cycles of hesitation, fear, frustration, and inconsistent results. More importantly, we'll explore the mental framework required to operate effectively when certainty is impossible, and every decision carries an element of risk. And that's what makes this subject so interesting. These ideas aren't limited to traders. They apply to anyone trying to succeed in an environment where the future cannot be predicted with complete confidence. Whether you're building a business, making financial decisions, pursuing a career, competing in sports, or simply trying to improve your life, you eventually encounter situations where you have to act without knowing exactly what will happen next. That's where Mark Douglas's ideas become especially powerful. He shifts attention away from external tools and toward the internal game. Most conversations about success focus on strategies, information, resources, market conditions, technology, or opportunities, but Douglas asks us to look somewhere else, inside our own minds. What if the biggest obstacles standing between us and better results aren't always external? What if some of them are created by the way we interpret events, manage uncertainty, respond to losses, and attach meaning to outcomes? This is one of the central challenges presented by Trading in the Zone. The book argues that psychological factors can matter far more than simply having more information or a more sophisticated analytical method. For anyone attempting to master a complex environment, that distinction is enormous. Douglas's own journey toward this realization makes the idea even more compelling because his conclusions weren't developed from theory alone. They were shaped by painful personal experience. Mark Douglas began trading in 1978. At that point, he already had a successful career as a commercial casualty insurance agency manager in Detroit. He was experienced, intelligent, ambitious, and accustomed to performing well professionally. From his perspective, it seemed reasonable to assume that the qualities that had helped him succeed in business would naturally carry over into trading. Why wouldn't they? He knew how to work hard. He understood business. He was capable of making decisions. He had already achieved professional success. It would be natural to believe that these qualities should provide a meaningful advantage in another competitive environment. But trading taught him a very different lesson. By 1981, only 3 years after beginning his trading journey, Douglas found himself dealing with severe frustration and serious financial difficulties. He had lost nearly everything he owned. His trading losses were significant, and the lifestyle he had built, which required a substantial level of income, added even more pressure to an already difficult situation. The financial stress and trading performance began feeding into each other. Losses created pressure. Pressure affected decisions, and those decisions contributed to further problems. It became a destructive cycle in which his personal circumstances and market performance were constantly influencing one another. What makes this story important is that his problem wasn't a simple lack of intelligence or effort. He wasn't someone who simply didn't care enough or wasn't willing to learn. Instead, he discovered that his previous success had not prepared him for a completely different psychological environment. Trading required something fundamentally different. Hitting that kind of low point can sometimes become the catalyst for a profound transformation. For Douglas, it became the beginning of a much deeper investigation into the psychology of trading. Beginning in 1982, he spent approximately 17 years intensely studying what he described as the psychological dynamics behind trading. Rather than simply searching for better market predictions, he began examining the internal processes that influence how traders think, feel, and behave when money is at risk. 17 years is an extraordinary amount of time to dedicate to a single question. That long investigation eventually contributed to his first book, The Disciplined Trader: Developing Winning Attitudes, published in 1990. He later founded Trading Behavior Dynamics, a consulting firm through which he worked with traders from many different backgrounds. His clients included beginners as well as experienced professionals, floor traders, hedgers, options specialists, and other market participants around the world. The significance of this journey is difficult to ignore. Nearly 2 decades of observation and personal experience had led him toward a conclusion that challenged one of the most common assumptions in trading, that better analysis alone would eventually solve the problem. So what exactly did Douglas discover? At the heart of his work was a fascinating incompatibility between the way human beings naturally think and the way financial markets actually behave. Our minds are designed to search for patterns, create expectations, establish cause and effect relationships, and use past experiences to anticipate what might happen next. In ordinary life, these abilities are extremely useful. If you touch a hot surface, you learn not to touch it again. If a particular road is consistently congested at a certain time, you learn to leave earlier. If someone repeatedly behaves in a certain way, you begin forming expectations about how they may behave in the future. Human beings naturally learn from experience and use that experience to create predictions. The problem is that markets don't operate according to the same predictable structure. Trading environments are dominated by probabilities, uncertainty, constantly changing conditions, and the actions of countless participants. A pattern that worked previously does not guarantee that it will work again in exactly the same way. A setup that produced a profitable trade yesterday can produce a loss today. The market doesn't owe us consistency simply because something happened before. This creates a major psychological challenge. The same mental mechanisms that help us navigate everyday life can become liabilities when applied incorrectly to an environment where uncertainty is unavoidable. It's almost as if the human mind is running an operating system designed for a world where events generally have understandable causes and relatively predictable consequences, while trading requires an operating system built around probability. And this brings us directly to the central premise of trading in the zone. Douglas argues that the solution to inconsistent trading isn't necessarily more analysis. It's not about endlessly searching for another indicator, another strategy, another prediction model, or another piece of market information. Instead, consistent profitability depends heavily on the trader's attitude and psychological state. That's a powerful idea because it challenges one of the most widespread beliefs among traders. Many people enter the market believing that their primary problem is a lack of knowledge. They think that if they could just discover the perfect strategy, understand one more indicator, find a better entry signal, or predict the next market movement with greater accuracy, everything would finally fall into place. So they continue searching. Another course, another indicator, another strategy, another chart pattern, another expert, another prediction. But Douglas suggests that this endless search can miss the real issue. Consistently successful traders develop a different relationship with uncertainty. He identifies 3 core beliefs that are particularly important. First, they understand that they don't need to know what will happen next in order to make money. That idea alone can completely change the way a person approaches trading. You don't have to predict the next candle. You don't have to know whether the next trade will be a winner. You don't need certainty before taking action. Instead, you need an edge, proper risk management, and the psychological ability to execute your plan without demanding that the market confirm your expectations. Second, successful traders genuinely accept that anything can happen, not just theoretically but emotionally. It's easy to say anything can happen. It's much harder to genuinely believe it when you're in a position and your money is exposed. If you truly accept uncertainty, you don't become shocked every time the market moves against you. You don't interpret an unexpected outcome as proof that something has gone terribly wrong. You understand that an individual trade is simply one possible outcome within a larger distribution of possibilities. Third, Successful traders recognize that every moment in the market is unique. Even when two situations look almost identical, they aren't necessarily the same. The participants are different. The emotional environment is different. The amount of liquidity may be different. The information available to traders may be different. The broader market context may have changed. A previous outcome does not guarantee the next one. So when a trade works, you take the result. When it doesn't work, you accept the loss. Then you move forward without allowing the previous outcome to control the next decision. Take a moment and consider how powerful those three beliefs really are. What would happen if you stopped believing that you needed to know what comes next? What would change if you genuinely accepted that unexpected outcomes are always possible? And how differently would you behave if you stopped treating every new situation as though it had to repeat something that happened in the past? This isn't just a lesson about trading. It's a broader lesson about uncertainty. Much of human frustration comes from expecting reality to behave according to our predictions. When reality doesn't cooperate, we become angry, fearful, disappointed, or confused. But uncertainty isn't a malfunction of reality. It's part of reality. To understand why Douglas's ideas were so different, it helps to look at how traders historically attempted to understand markets. Before technical analysis became widely accepted, particularly during the period before Douglas began trading in 1978, fundamental analysis was considered the dominant approach. Fundamental analysis attempted to understand an asset by examining the underlying factors believed to influence its value. Analysts studied interest rates, economic conditions, company financial statements, supply and demand, weather patterns, geopolitical developments, and countless other variables. They gathered information, constructed models, analyzed relationships, and attempted to determine what an asset should be worth at some future point. It was an incredibly detailed process. In many ways, it resembled scientific investigation. The assumption was that if you could collect enough information and understand enough variables, you could create a sufficiently accurate projection of future prices. But there was a significant problem. These models often struggled to account for one enormous variable: other human beings. Markets don't move simply because an economic model says a particular asset should be worth a certain price. Markets move because people buy and sell. And people don't always behave rationally. They become afraid, they become greedy, they become impatient, they become overconfident. They react to rumors, expectations, headlines, emotions, memories, and the actions of other participants. A trader might completely ignore the fundamental picture and still have enough influence, especially over short periods, to move the market. Floor traders, for example, could respond instantly to changing conditions without necessarily considering the same fundamental variables used by analysts. Their decisions could be driven by immediate perceptions, emotional reactions, positioning, and short-term opportunities. In other words, human behavior itself became a major component of market movement. This exposed a limitation in purely fundamental approaches. You can analyze every available economic factor and still be unable to predict exactly how people will respond to that information. And that realization helped create space for another approach: technical analysis. Technical analysis was initially met with considerable skepticism. In the late 1970s, many established financial institutions viewed chart-based approaches as little more than speculative pattern recognition, and some regarded them as almost mystical. The idea that someone could look at a price chart and identify potential future opportunities seemed questionable to many traditional analysts. Yet over time, technical analysis became increasingly widespread. Today, traders across different markets and strategies use some form of technical analysis to identify patterns, trends, momentum, support and resistance, volatility, and potential opportunities. Its adoption demonstrated that price itself contains information about the collective behavior of market participants. But technical analysis created a new and equally important realization. Even when traders have a useful analytical method, knowing what to do and actually doing it are two completely different things. This is what Douglas refers to as the psychological gap. A trader may understand the market, they may recognize a setup, they may identify a pattern, they may even correctly anticipate the next move. And yet when the moment arrives to execute the trade, something changes. Suddenly, hesitation appears. Fear enters the picture. The trader begins questioning the setup. What if I'm wrong? What if this time is different? What if I enter and the market immediately reverses? What if I lose money? So the trader waits. The opportunity passes. Then the market moves exactly as expected, and the trader watches from the sidelines, realizing that the analysis was correct but the execution was missing. That experience can be incredibly frustrating. Imagine watching a chart and recognizing what appears to be a strong setup. You believe the market is likely to move higher. You have studied your strategy. You've seen similar situations before, everything seems to align. But when the moment comes, you don't act. You hesitate. Then the price moves exactly as you expected. The frustration isn't necessarily because your analysis was wrong. It's because you were unable to trust yourself enough to execute. This reveals an important distinction. Accurate prediction and effective execution are not the same skill. A person can be excellent at identifying opportunities and still struggle to capitalize on them. And once a trader recognizes this pattern, the questions become much deeper. If the strategy works, why am I unable to follow it? If I can identify the setup, why do I hesitate? If I know my risk is controlled, why does a single loss feel so threatening? Why do I become emotionally attached to individual trades? Why does a previous loss influence the next decision? Why do I sometimes enter too early, exit too quickly, or refuse to take a valid setup? These questions eventually force the trader to look in a different direction. Instead of endlessly analyzing the market, they begin analyzing themselves. And that is where the real psychological journey begins. The problem may not be the market, it may not be the strategy, it may not even be the amount of information available. The problem may be the trader's relationship with uncertainty, risk, fear, expectations, and personal identity. That realization represents one of the most important shifts in trading in the zone. Moving the focus from trying to control the market to learning how to control your own responses to the market. Because the market cannot be controlled. The next trade cannot be guaranteed. The outcome cannot be known in advance. But your beliefs, your reactions, your risk, your discipline, and your willingness to accept uncertainty can be developed. And that is where consistent performance begins. This is where his work truly becomes indispensable. The real promise of mastering trading psychology is that it can make the act of trading feel as natural, simple, and stress-free as it feels when you're simply watching the market and imagining yourself taking the trade. The goal is effortless execution. It's about bringing your internal state into such close alignment with the endless opportunities the market continually provides that taking action no longer feels like a struggle. There is no constant internal resistance, no endless hesitation, and no emotional battle every time a decision has to be made. That sounds like an ideal psychological state for anyone, but Douglas also makes an important observation. Reaching this level of mastery is extraordinarily rare. He compares the achievement metaphorically to reaching the moon. It may appear close enough to imagine, but actually getting there requires an incredibly difficult journey. Only a relatively small number of people manage to develop the consistency necessary to operate successfully in this environment, and Douglas draws a very clear line between those consistently successful traders and everyone else. The winners, he suggests, can generate profits with a level of ease and calmness that almost makes the process look effortless. They aren't constantly fighting themselves, questioning every decision, or becoming emotionally overwhelmed by individual outcomes. For the majority of traders, however, consistency seems to disappear just when they think they're finally getting close to it. They experience moments of success, followed by setbacks. They develop confidence, then lose it. They discover a strategy that appears to work only to abandon it after a few losses. They make money, become overconfident, take unnecessary risks, and then give those profits back. Over time, this creates an exhausting emotional cycle filled with fear, anger, frustration, anxiety, disappointment, regret, and sometimes even a feeling of betrayal by the market itself. The emotional and financial cost of remaining trapped in that cycle can be enormous. So if intelligence isn't the deciding factor, and if analytical ability isn't enough, what actually separates these two groups of traders? This is where the paradox of trading begins to become clearer. Contrary to what many people assume, consistently successful traders aren't necessarily smarter than everyone else. They aren't automatically more educated, more hardworking, or naturally better at analyzing markets. They don't necessarily possess some extraordinary intellectual advantage that the average trader simply doesn't have. In fact, Douglas highlights something that is surprisingly counterintuitive. Many consistent losers are highly intelligent and accomplished people. They can include successful doctors, lawyers, engineers, executives, entrepreneurs, and CEOs. These are people who have already demonstrated exceptional intelligence and discipline in other areas of life. And perhaps even more surprising is the fact that some of the industry's strongest market analysts can turn out to be terrible traders. That sounds almost contradictory. If someone can analyze markets exceptionally well, shouldn't they automatically be able to trade exceptionally well? Apparently not, and that's the point. The critical difference isn't necessarily how much someone knows, it's how they think, how they respond, and how they behave when the information they possess is exposed to uncertainty. The defining characteristic of consistently successful traders is a unique mindset. They have developed a particular collection of attitudes and beliefs that allows them to remain disciplined, focused, confident, and emotionally stable, even when market conditions become unfavorable. It's an internal framework. Their advantage isn't that they never experience fear. They aren't emotionless machines. They aren't somehow immune to uncertainty or incapable of feeling uncomfortable. Instead, they've developed an internal state in which fear doesn't control their decisions. That's an important distinction. Mastery doesn't mean eliminating every uncomfortable emotion. It means preventing those emotions from taking over the decision-making process. The trader can recognize fear without allowing fear to dictate behavior. They can experience uncertainty without desperately trying to eliminate it. They can experience a loss without interpreting that loss as a personal failure. They can experience a winning trade without becoming convinced that they suddenly understand everything about the market. This is similar to mastering a complex physical skill. Think about a professional golfer. A technically perfect swing isn't enough. If the golfer becomes tense, distracted, afraid of failure, or obsessed with the consequences of every shot, the mechanics can break down under pressure. Consistency comes from both technical ability and the mental state surrounding that ability. Trading works in a similar way. You can have a profitable strategy and still execute it poorly because your psychological state interferes with your decisions. And this is one reason trading contains so many paradoxes. Many principles that help us function effectively in ordinary life can produce completely different results in the trading environment. In everyday life, avoiding unnecessary risk is generally sensible. We learn to protect what we value. We try to avoid losing money. We try not to make mistakes. We prefer situations where we know what we're getting into. These instincts are often useful, but in trading, they can become obstacles. Consider the concept of risk-taking. Trading is inherently risky. Every trade has an uncertain outcome. There is no trade that comes with a guaranteed result. So it seems completely reasonable to assume that anyone who enters a trade is, by definition, a risk-taker. Most traders probably wouldn't hesitate to describe themselves that way. But Douglas points out that this assumption can be misleading. Yes, when you place a trade, you are exposing your capital to risk. That's undeniable. But exposing yourself to risk is not the same thing as psychologically accepting risk. That distinction is crucial. A trader can technically take a risk while emotionally refusing to accept the possibility of losing. They may enter the position, but internally they expect the trade to work. They may understand that losses are possible intellectually, yet become emotionally shocked when the loss actually occurs. They may say, "I know I can lose," but their behavior reveals that they haven't genuinely accepted that possibility. Consistently successful traders approach risk differently. They don't merely take risk, they accept it. They understand that an individual trade can produce any outcome allowed by their trading edge and market conditions. They accept that even a high-quality setup can fail. They accept that being right about the overall idea doesn't guarantee that a particular trade will be profitable. Most importantly, they become psychologically comfortable with the consequences of uncertainty. That acceptance changes everything. A successful trader can enter a position knowing that the trade might lose. And if it loses, they don't experience the same emotional shock. They don't automatically question their intelligence. They don't immediately abandon their strategy. They don't revenge trade simply because they feel the market has taken something from them. They don't desperately try to win the money back. They simply recognize the outcome as one possibility within the larger statistical process. That allows them to enter and exit trades, including losing trades, without hesitation or emotional chaos. Their discipline remains intact because they aren't demanding certainty from the market. Their confidence remains stable because their confidence isn't based on the assumption that every individual trade must work. Most traders, however, haven't reached that level of psychological acceptance. They may understand risk intellectually, but emotionally they still resist it. And that resistance creates fear. In a market where uncertainty is unavoidable, trying to eliminate uncertainty is a recipe for frustration. Think about how contradictory that really is. You're operating in an environment where risk cannot be removed completely, yet your mind is constantly trying to find a way to remove it. You want the perfect setup. You want confirmation. You want additional information. You want another indicator. You want to know that you're right before you commit. But the market cannot provide that guarantee, and when the guarantee never comes, hesitation begins. This is where our natural human fears become particularly dangerous. Douglas identifies 4 primary fears that can influence trading behavior: the fear of being wrong, the fear of losing money, the fear of missing out, and the fear of leaving money on the table. He associates these fears with a very large proportion of trading mistakes. Think about how powerful these 4 fears can become. The fear of being wrong can make you refuse to take a valid trade because you're afraid your analysis might fail. The fear of losing money can make you exit a position too early, move a stop loss, avoid a perfectly acceptable setup, or hesitate to execute your strategy. The fear of missing out can cause you to chase a move after the ideal entry has already disappeared. And the fear of leaving money on the table can make you hold a winning trade far longer than your plan allows, because you can't tolerate the idea of watching the market continue without you. Each fear can distort perception, and that's an important point. These errors aren't necessarily created by the market itself. The market is neutral. It generates movement. It produces information. It creates opportunities and outcomes. But it doesn't decide how you interpret those events. The market doesn't force you to become afraid. It doesn't force you to revenge trade. It doesn't force you to chase a position. It doesn't force you to move your stop. It doesn't force you to freeze. Your interpretation of what is happening determines your emotional response, and your emotional response influences your behavior. So the problem is often internal. As Douglas explains, faulty trading attitudes and perspectives can create fear where trust and confidence should exist. The same market movement can be interpreted very differently by 2 traders. One trader sees an ordinary losing trade that falls within the expected distribution of outcomes. Another trader sees the same loss as proof that the strategy is broken, that the market is against them, or that they personally have failed. The price movement is identical. The psychological interpretation is completely different. This is why the market itself can remain neutral while producing radically different emotional experiences for different people. Successful traders develop the flexibility to move in and out of positions without becoming emotionally attached to every outcome. They can participate when an opportunity fits their plan and step away when it doesn't. They don't need every movement to become a trade. They don't need every trade to become profitable. They don't need the market to validate their intelligence. But there is another extreme. When traders aren't controlled by fear, they can sometimes swing toward recklessness. Instead of being too afraid to act, they become too eager to act. They overtrade. They increase position sizes. They ignore risk limits, They enter trades simply because they're bored. They chase momentum. They believe they have figured out the market after a few successful trades. And eventually, reckless behavior creates losses, which brings the fear back. This produces an emotional roller coaster. Fear leads to hesitation. Hesitation leads to missed opportunities. Missed opportunities create frustration. Frustration can lead to impulsive behavior. Impulsive behavior creates unnecessary losses. Those losses increase fear, and the cycle starts again. It can become a self-reinforcing psychological loop. One of the most interesting parts of Douglas's argument is that fear can sometimes help create the very outcome the trader is trying to avoid. Imagine a trader who is deeply afraid of being wrong. That fear changes the way they interpret information. They may search for reasons not to enter. They may hesitate until the opportunity disappears. They may enter late after the market has already moved. They may exit prematurely at the first sign of discomfort. They may constantly change their strategy. Eventually, their behavior can create a poor result. In that sense, the fear of being wrong can contribute directly to becoming wrong. Fear becomes part of the mechanism producing the outcome. That's a powerful psychological insight. Fear also narrows perception. When you're afraid, your attention becomes highly concentrated on the thing you want to avoid. A trader who is terrified of losing may see every small price movement against their position as a warning sign. They stop seeing the broader context. They stop seeing alternative possibilities. They stop evaluating the trade objectively. The mind becomes focused on danger. As a result, potentially important information can disappear from awareness. An opportunity may be visible, but fear prevents the trader from recognizing it. Or the trader may recognize the opportunity but be unable to act. Then, once the moment has passed, everything suddenly looks obvious. The chart moves exactly as expected. The setup becomes clear, and the trader realizes what they missed. This is closely connected to what Douglas describes as the black hole of analysis. The black hole of analysis is the belief that if you simply acquire enough knowledge, study enough charts, understand enough indicators, and become a sufficiently sophisticated analyst, you can eventually eliminate uncertainty and avoid being wrong. It sounds logical. If knowledge helps us make better decisions, then more knowledge should make our decisions even better. But in trading, this logic eventually reaches a limit. The market contains too many variables. Some variables are visible, others are hidden. Some are measurable, others are psychological. Some are predictable to a degree. Others can change without warning. And every participant in the market represents another variable. Every buyer and seller contributes to the constantly changing environment. Every participant has their own beliefs, fears, goals, information, expectations, and emotional reactions. That means there is no possible amount of knowledge that can allow you to anticipate every conceivable way the market could behave. You can study endlessly and still be surprised. You can become an exceptional analyst and still experience losses. You can understand a setup perfectly and still watch it fail. You can predict the general direction and still lose money on a specific trade. The task of eliminating uncertainty through analysis is therefore impossible. That's the trap. You keep learning because you believe the next piece of information will finally provide the certainty you're looking for. But once you find that information, you discover another variable. So you search again. Another indicator, another strategy, another book, another analyst, another market model, another prediction. The process can continue indefinitely, and eventually the trader discovers that the problem isn't a lack of information. The problem is the expectation that information can eliminate uncertainty. It can't. The solution isn't to eliminate risk through endless analysis. The solution is to redefine the relationship you have with risk. Instead of asking, "How can I know this trade will work?" the better question becomes, "Can I accept the possibility that this trade might not work while still following my plan?" That is a completely different psychological position. It moves you away from prediction and toward execution. The goal isn't perfect certainty. The goal is disciplined action under uncertainty. This exposes one of the most deeply rooted cognitive tendencies humans possess. our desire to create certainty in environments where certainty doesn't exist. We naturally want to know what's going to happen. We want reassurance before we act. We want evidence that we're right. We want guarantees. But the market doesn't provide guarantees. The market doesn't reward someone simply because they are confident in their prediction. Instead, successful trading depends heavily on the ability to execute a defined process while accepting that the outcome remains uncertain. That's why the distinction between prediction and execution matters so much. You don't need to predict perfectly. You need to execute consistently. And to execute consistently, you need confidence. But genuine confidence doesn't come from believing that you know what the market will do. It comes from trusting yourself to handle whatever happens next. That is a much deeper form of confidence. You're not saying, "I know this trade will win." You're saying, "I don't know whether this trade will win, but I trust myself to follow my process regardless of the outcome." That trust is built internally. It doesn't come from another market forecast. It doesn't come from someone on television telling you what the market will do. It doesn't come from collecting endless technical indicators. It comes from training your mind to stop interpreting uncertainty as a threat. The psychological challenge is therefore to change the beliefs and attitudes that automatically produce fear. You have to learn how to operate without fear controlling your decisions, while also avoiding the opposite extreme of reckless behavior. The objective is balance, not fearlessness, not recklessness, not blind confidence, but calm acceptance. And this brings us to another fascinating part of Douglas's discussion, the extraordinary appeal of trading itself. Trading can offer something that many other areas of life rarely provide: freedom, almost unlimited freedom. Once your financial account and market access are established, you can potentially buy or sell whenever opportunities appear. There are relatively few external restrictions compared with many traditional careers. You aren't necessarily required to wait for a manager. You don't need someone to approve every decision. You can choose when to participate. You can choose when to stay out. You can decide how much capital to risk within your own rules. For someone who values independence, that freedom can be incredibly attractive. It can feel like a form of creative expression. You observe the market, form an idea, define your risk, make a decision, and immediately receive feedback. The possibilities can seem almost limitless. Douglas even points to the enormous number of potential combinations available in complex markets involving instruments such as bond futures and options. The sheer variety of possible strategies and positions gives you an idea of just how vast the trading environment can become, and that freedom is undeniably seductive. But here's the paradox. The very freedom that makes trading so attractive can also become one of its greatest psychological dangers. Unlimited freedom creates unlimited choices, and unlimited choices create responsibility. In many areas of life, external structure tells us what we are supposed to do. A job gives you a schedule. A school gives you assignments. A manager gives you deadlines. A team gives you responsibilities. A traditional career often provides boundaries that guide your behavior. Trading can remove many of those boundaries. No one may stop you from taking another trade. No one may force you to stop after a losing streak. No one may prevent you from increasing your position size. No one may tell you that you've reached your daily limit. No one may physically stop you from abandoning your strategy. You have the freedom to do almost anything. And that is precisely why trading can become psychologically difficult. Unlimited freedom means you are responsible for creating your own rules. It means you have to decide when to act, when not to act, how much to risk, when to stop, and how to respond when things don't go according to plan. The market gives you possibilities, it doesn't give you discipline. That has to come from you. And this is why the curse of unlimited freedom can be so powerful. When there are endless possibilities, the mind can constantly search for the next opportunity. One trade becomes another. One setup leads to another. One loss creates a desire to recover. One win creates a desire to make even more. Without psychological structure, freedom can quickly become chaos. The trader may believe that more freedom means more opportunities to make money, when in reality, more freedom can also create more opportunities to make mistakes. This is one of the specialized psychological challenges that makes trading so different from ordinary work. You are not only managing the market, you're managing yourself in an environment where almost every decision is ultimately your own. And once you understand that, The real challenge of trading becomes much clearer. The market isn't simply testing your analytical ability, it's testing your relationship with freedom, uncertainty, risk, fear, confidence, and personal responsibility. And that is exactly why mastering the internal game can become far more important than endlessly searching for another external advantage. These are challenges that very few people are genuinely prepared to handle. It's a remarkable paradox, isn't it? The very thing that attracts us to trading can eventually become the very thing that causes our downfall. It's almost like being handed the keys to a high-performance supercar and being told you can drive anywhere you want, but never being given any lessons on how to control it. You have enormous freedom. You can accelerate whenever you want, change direction whenever you want, stop whenever you want, and choose your own destination. But without internal safeguards, clear rules, and the discipline to follow them, eventually that freedom can turn into a crash. That's exactly what makes trading so psychologically demanding. Unlike ordinary society, where we are surrounded by external rules, laws, expectations, and boundaries that guide our behavior, the market provides very little structure for the individual trader. Society tells us what we can and cannot do. Workplaces have policies, schools have schedules, sports have rules. Even many traditional gambling games have clearly defined structures. Think about a typical gambling game. There are established rules. There are specific betting amounts. There are clearly defined turns. There is usually a beginning and an ending to each round. At some point, you're forced to make a decision. Trading is fundamentally different. No one is standing beside you telling you how much you should risk. No one is forcing you to decide your stop loss before entering. No one is physically stopping you from taking another position after a loss. No one is telling you that you've reached your daily limit. No one is forcing you to close a trade that is clearly moving against you. You have to create those boundaries yourself, and that is where the psychological challenge becomes enormous. Without that internal structure and self-imposed discipline, traders can quickly become what Douglas describes as passive losers. A passive loser isn't necessarily someone who doesn't care about losing. In many cases, it's someone who cares so much about losing that they become unable to act when action is required. They see a trade moving against them. They know their original idea may be invalid. They may even have a predetermined exit point. But instead of accepting the loss, they hesitate. They tell themselves the market will turn around. They wait a little longer, then a little longer. The loss grows, and eventually they aren't managing the trade anymore. They're simply hoping. Hope has replaced discipline. The trader isn't making decisions based on the original plan. They're emotionally waiting for the market to rescue them. And in that psychological vacuum, the market can continue moving against them without mercy. It can take far more from them than they originally intended to risk. That's the brutal reality of unlimited freedom. The market doesn't have to protect you from yourself. And this leads to another major paradox. The very freedom of creative expression that attracts people to trading is often the reason they resist creating the internal rules required for consistent success. People enter trading because they want freedom. They don't want a boss. They don't want someone controlling their schedule. They don't want to be told what to do. They want independence. They want flexibility. They want the ability to make their own decisions. But eventually, successful trading demands structure. You need rules. You need limits. You need consistency. You need predetermined risk. You need to know when to stop. And psychologically, that can feel like giving up the freedom you originally wanted. It's almost as if creating rules feels like betraying the very reason you entered the market in the first place. You wanted unlimited freedom, but now you're being told that you need boundaries. That contradiction creates resistance. And sometimes that resistance becomes so strong that it takes significant pain and repeated losses before a trader finally becomes willing to accept the discipline required for consistency. Unfortunately, pain is often the teacher that people listen to only after everything else has failed. Another major issue is personal responsibility. Trading makes it remarkably easy to avoid taking complete responsibility for what happens. When a trade succeeds, we're often quick to take credit. We say our strategy worked, our analysis was right, our timing was excellent, we knew what was going to happen. But when the trade loses, suddenly the explanation changes. The market was manipulated. The news surprised us. The broker caused a problem. There was unexpected volatility. Something happened that we couldn't possibly have known. There is always another variable to blame. This tendency is deeply human. We naturally want to protect our self-image. We want to believe that success proves our competence, while failure must have been caused by something outside our control. But trading exposes that psychological habit very quickly. Douglas describes a related pattern as the random trading trap. A trader may spend hours carefully analyzing the market. They identify a setup. They define their entry. They establish their risk. They develop a plan. Everything is prepared. And then, at the last moment, a friend calls, or a broker offers a hot tip, or someone online predicts a sudden move. The trader abandons the original plan and takes the new trade instead. Sometimes that random trade wins. And that's where the trap becomes even more dangerous, because the trader may interpret that unexpected win as evidence that the impulsive decision was actually a good decision. They may think, "I trusted my instincts, and it worked." But the fact that a random decision produced a profitable outcome doesn't mean the decision was disciplined or intelligent. It may simply mean that the outcome happened to be favorable. And here's the subtle psychological consequence. If the trader's carefully planned trade later turns out to have been a big winner, while the random trade they actually took also produces a profit, they may still avoid recognizing the importance of following their own process. If the random trade loses, they can blame the friend. They can blame the broker. They can say, "I only took that trade because someone else told me to." Either way, responsibility becomes diluted, and that's psychologically convenient. If you take your own well-researched trade and it fails, you have to confront your own decision. There's nowhere to hide. But if you take someone else's idea, you can create a psychological escape route. You can say the analysis belonged to someone else. The responsibility belonged to someone else. The mistake belonged to someone else. This is one of the reasons random trading can become so destructive. It doesn't merely create inconsistent results. It prevents the trader from developing a genuine relationship with responsibility. And then we encounter another phenomenon Douglas calls the big winner anomaly. Any individual trade can become a huge winner purely by chance. A trader might have no real edge. They might have poor risk management. They might make random decisions. They might violate their own rules. And yet, one trade can still produce an enormous profit. The market doesn't require you to be disciplined before rewarding you. That's what makes the situation so psychologically dangerous. A random trade can succeed. A reckless trade can succeed. A poorly researched trade can succeed. A trader can break every rule and still make money on a particular occasion. And when that happens, the result can reinforce the wrong behavior. The trader may conclude that discipline isn't necessary. They may believe their instincts are superior to their plan. They may begin taking more random trades. They may increase their risk. They may become more confident in behavior that actually has no reliable foundation. This is random reinforcement. The reward strengthens the behavior, even though the behavior itself may be fundamentally flawed. It's similar to pulling a slot machine lever and occasionally receiving a large payout. The occasional reward can be powerful enough to keep the behavior alive. In trading, the consequences can be even more dangerous because the trader can convince themselves that the winning outcome proves skill. They may not recognize that a profitable outcome and a good decision are two completely different things. A bad decision can produce a good result. A good decision can produce a bad result. That's one of the most important distinctions a trader has to understand. If you judge every decision only by its immediate outcome, you'll eventually train yourself to repeat bad decisions when they happen to work, and you'll abandon good decisions when they temporarily fail. That's the opposite of consistency. The avoidance of responsibility is a fundamental human tendency. But in trading, it becomes especially dangerous because the consequences are immediate and financial. You can't hide from the numbers. You can't negotiate with your account balance. You can't convince a loss to become a profit simply by explaining why it happened. The market doesn't care about your intentions. It responds to orders, expectations, behavior, and constantly changing conditions. So if the market isn't going to provide the structure required for disciplined behavior, and if our natural psychological tendencies can easily lead us toward destructive decisions, where does the transformation actually begin? It begins inside the mental environment of the trader. More specifically, it begins with beliefs and attitudes. This is one of Douglas's most important ideas. The goal isn't simply to find a better strategy. The deeper goal is to systematically remove the fear and recklessness that interfere with consistent execution. In other words, you're rebuilding your internal operating system. You're identifying the beliefs that create emotional reactions. You're examining the assumptions that produce hesitation. You're challenging the interpretations that turn ordinary market uncertainty into psychological threats. And then you're replacing those patterns with attitudes that support disciplined action. It's an internal restructuring. You're rebuilding from the inside out. Instead of constantly asking, what else can I learn about the market? You begin asking, what do I need to change about the way I respond to the market? That is a completely different question, and it changes the direction of your development. You stop endlessly searching for the magical algorithm. You stop believing that the perfect indicator is somewhere just beyond your reach. You stop assuming that one more piece of information will finally remove uncertainty. Instead, you begin debugging your mental software. That phrase captures the idea perfectly. Your strategy may not be the only thing that needs improvement. Your psychological programming may need an upgrade as well. Many traders get trapped because they believe more market knowledge is the ultimate path to success. They study more charts, they read more books, they watch more analysts, they learn more indicators, they analyze more historical data, they search for more sophisticated strategies. And there's nothing inherently wrong with learning. Knowledge has value, technical skills matter, a useful strategy matters. But Douglas argues that the consistency you're searching for ultimately comes from your mind, not from the market. Imagine two traders. The first trader has a relatively average technique, nothing extraordinary. Their strategy works often enough to provide an edge, but it's certainly not revolutionary. However, their mindset is extremely strong. They don't distort information because of fear. They don't hesitate when their setup appears. They don't revenge trade after a loss. They don't become reckless after a win. They accept risk before entering. They follow their rules. They don't need every trade to work. Now consider the second trader. This person is an exceptional analyst. They understand markets at an extremely sophisticated level. They can identify patterns that most people miss. They have studied countless variables. Their technical knowledge is extraordinary, but they are emotionally unstable. They become afraid when a position moves against them. They hesitate when it's time to execute. They move their stops. They overtrade after losses. They become greedy after wins. They second-guess their decisions. They constantly change strategies. Which trader is more likely to achieve consistent results? The first one. And that's the paradox. A trader with a less sophisticated method, but a disciplined psychological framework, can produce significantly better results than an exceptional analyst whose emotions constantly interfere with execution. This completely reverses the traditional understanding of trading success. Analysis is important, technique is important, knowledge is important, but attitude determines how effectively all of those tools are actually used. The right attitude can make the process simpler. It can make execution easier. It can make trading more enjoyable. And most importantly, it can reduce the emotional friction that causes traders to sabotage their own decisions. This brings us to Douglas's concept of the zone. Many traders experience a period early in their trading journey when everything seems effortless. They may have a few successful trades. Perhaps they make money quickly. They begin feeling confident. They aren't afraid yet. They enter trades naturally. They don't overthink. They don't hesitate. Everything seems easy. They might describe themselves as being in the zone. And on the surface, this can look remarkably similar to the psychological state experienced by highly skilled professionals. But Douglas makes an important distinction. This early, carefree state is not necessarily the true trading zone. In fact, it can be extremely dangerous. Why? Because the trader's confidence may not be based on genuine acceptance of risk. It may be based on ignorance. It may be based on beginner's luck. They haven't experienced enough losses yet to understand what the market can actually do. They don't fear risk because they haven't yet experienced its consequences. They don't hesitate because they haven't yet developed painful associations with losing. They feel invincible because the market has not yet challenged that belief. So their carefree state is not necessarily mastery. It can simply be a temporary absence of fear. And that difference becomes obvious when the first serious loss arrives. The true psychological zone is something very different. Douglas describes it as a state of mind that is inherently creative. You're able to respond instinctively. You don't become paralyzed by the fear of making mistakes. You don't have to endlessly calculate every possible outcome. You don't constantly second-guess yourself. You're able to act based on your well-developed process while remaining open to whatever the market does next. It's very similar to what athletes call a flow state. The actions become natural. The mind isn't overloaded with unnecessary internal conflict. You aren't constantly fighting yourself. But this state cannot simply be forced into existence. You can't sit down and tell yourself, "Now I'm going to be in the zone." It doesn't work that way. Instead, you create the internal conditions that make the zone possible, and those conditions are developed through the cultivation of a positive, disciplined, and winning attitude. So what does that winning attitude actually look like? It involves expecting a positive result from your efforts while simultaneously accepting that the outcome of any individual attempt may be different from what you expect. You can believe in your ability without demanding certainty. You can expect your process to produce positive results over time while accepting that individual trades may fail. You can recognize that every outcome also provides information about your current level of development. A loss isn't necessarily proof that you are incapable. It may simply reveal something about your execution, your assumptions, your strategy, or your psychological development. And sometimes the lesson is simply that losing is part of the process. That raises another important question. How do you distinguish genuine confidence from false confidence? How do you know whether your confidence is based on skill and understanding or simply on inexperience? That distinction is critical. A beginner who has experienced 10 winning trades may feel extremely confident, but 10 winning trades don't automatically prove mastery. They may simply represent a favorable sequence of outcomes. The trader may not yet understand the full range of possible market behavior. They may not have experienced a serious drawdown. They may not have seen their strategy fail repeatedly. They may not have experienced the emotional pressure that appears when real uncertainty becomes unavoidable. So early confidence can sometimes be nothing more than blissful ignorance. The true psychological zone is different because it is built on awareness. The experienced trader understands that anything can happen. They understand that losses are possible. They understand that their analysis can be wrong. They understand that their strategy can experience losing streaks, and yet they can still execute calmly. That's confidence built on acceptance rather than illusion. Eventually, however, the beginner who is operating from carefree ignorance usually encounters a loss. And that first significant loss can completely transform their psychological state. The carefree feeling disappears. Suddenly, the market doesn't seem so friendly anymore. The trader begins thinking, "The market did this to me." And that's where the blame game begins. Douglas describes this reaction as being connected to something deeply rooted in human psychology. When people experience something that feels unfair or uncontrollable, they can react with a sense of betrayal and powerlessness. It can resemble the emotional experience of childhood, when something we valued was suddenly taken away from us and we didn't understand why. We naturally ask, "Why did this happen to me?" In trading, that same psychological pattern can appear. The trader believes they did everything right. They followed the setup. They believed the analysis. They expected the trade to work, and then the market moved against them. Instead of accepting the outcome as one of many possibilities, they interpret it as an injustice. The market betrayed them. The market manipulated them. The market took their money. The market shouldn't have behaved that way. But this is precisely where the conflict between social conditioning and market reality becomes obvious. In ordinary society, we develop expectations about fairness and reasonable behavior. If someone violates an agreement, there may be consequences. If a company treats you unfairly, there may be legal protections. If someone breaks a rule, there may be a system designed to respond. We grow accustomed to living within structures where expectations can sometimes be enforced. The market doesn't work that way. The market doesn't owe you fairness. It doesn't owe you a winning trade. It doesn't care how carefully you prepared. It doesn't care how confident you were. It doesn't care how much time you spent analyzing the chart. It doesn't care how badly you need the money. The market simply responds to the collective actions of participants. And in a zero-sum environment, one participant's gain can correspond to another participant's loss. Blaming the market for producing an outcome you didn't want is therefore a sign that you haven't fully accepted the nature of the environment you're participating in. If you project ordinary social expectations onto the market, you're setting yourself up for disappointment. You expect fairness, the market provides probability. You expect consistency, the market provides uncertainty. You expect your preparation to guarantee an outcome. The market provides no such guarantee. You expect that being right should produce a reward. The market can prove you right about the idea and still make you lose money on the trade. That mismatch creates frustration, and the more strongly you resist reality, the more emotional pain you experience. The solution is one of the most important principles in Douglas's framework: absolute responsibility. Taking responsibility means accepting, at the deepest level of your identity, that you are responsible for your decisions as a trader. Not the market, not your broker, not your friend, not the news, not the analyst you followed. You are responsible for how you interpret information, how you manage risk, whether you follow your rules, and how you respond to outcomes. That doesn't mean you control the market. You don't. It means you accept responsibility for your side of the interaction. This sounds simple, but psychologically it's extremely difficult. Because once you accept complete responsibility, you lose the comfort of excuses. You can no longer hide behind the market. You have to examine your decisions honestly. And Douglas identifies two major psychological obstacles that appear when traders fail to fully embrace this responsibility. The first is that you develop an adversarial relationship with the market. The market becomes your opponent. It's you versus the market. You start thinking in terms of winning and losing battles. You feel angry when the market moves against you. You resent it. You feel betrayed. You become determined to prove yourself right. And suddenly, instead of seeing the market as a constantly changing stream of opportunities and information, you see it as an enemy that must be defeated. That mindset creates enormous emotional pressure. The second obstacle is more subtle. You begin believing that your trading problems can be solved through more market analysis. You return to the black hole. You think, maybe I just need more information. Maybe another indicator will fix it. Maybe another strategy will fix it. Maybe another chart pattern will prevent future losses. Maybe another analyst will finally tell you exactly what you need to know. But the problem isn't necessarily a lack of information. The problem may be how you're interpreting and responding to the information you already have. The market presents information neutrally. Your mind assigns meaning to it. A price movement is simply a price movement. You may interpret it as danger. Another trader may interpret it as opportunity. The market produces the same information. The difference exists inside the trader. If you perceive every unexpected movement as a threat, your fear will interfere with your ability to recognize opportunities. Fear blocks perception. Anger narrows judgment. Regret keeps your attention trapped in the past. Betrayal creates resentment. Despair destroys confidence. Disappointment creates emotional resistance. And when those emotions dominate your internal state, you become less capable of responding naturally to the market. To participate effectively in the market's flow, your mind has to become relatively free from these emotional distortions. And again, that comes back to responsibility. When you accept responsibility for your own responses, you stop demanding that the market behave differently for you. You stop asking the market to make you feel safe. You stop expecting certainty. You stop needing every trade to prove that you're right, and that creates psychological freedom. But even after recognizing the need for responsibility, another powerful pattern can appear. Douglas refers to it as the revenge cycle. After experiencing a painful loss, the trader's instinct may be to fight back. The thought becomes, I'm going to beat the market next time. The trader wants to recover what was lost. They want to prove themselves. They want to demonstrate that the previous loss was an exception. And one of the easiest ways to express this desire is by seeking more knowledge. They start studying again. They search for better strategies. They analyze more charts. They consume more information. They tell themselves they're preparing to come back stronger. But beneath that search for knowledge, there may be a hidden psychological agenda. The goal isn't necessarily to become a better trader. The deeper goal may be to avoid experiencing the same pain again. The trader isn't simply trying to understand the market. They're trying to find a way to guarantee that they won't be wrong. They're trying to eliminate uncertainty. They're trying to protect their ego. They're trying to prove something. And that's where the search for knowledge becomes another form of avoidance. Because if the real objective is to avoid pain, no amount of information will ever be enough. There will always be another possibility, another variable, another uncertainty, another way the market can surprise you. And until the trader learns to accept that reality, the cycle continues. Loss, pain, blame, revenge, more analysis, temporary confidence, another trade, another unexpected outcome, and eventually another emotional reaction. Breaking that cycle requires something much deeper than another strategy. It requires changing the way you relate to risk, uncertainty, responsibility, and yourself. This creates a dilemma that can feel impossible to resolve and, ironically, can lead directly to self-sabotage. The more knowledge you accumulate without developing the psychological framework to use that knowledge properly, the more execution problems you can actually create. Instead of becoming more confident, you may become more hesitant. Instead of acting when your signals are clear, you may start second-guessing every decision. You may analyze a setup repeatedly, search for reasons why it could fail, and eventually do nothing at all. The very knowledge that was supposed to make you better can end up paralyzing you. And the reason this happens is deeply connected to the way the human mind is designed. Our minds are incredibly powerful at protecting us from pain, whether that pain is physical, financial, or emotional. When something threatens us, our psychological system immediately begins looking for ways to reduce that threat. Sometimes we do this consciously. We rationalize, we justify, we make excuses. We search for explanations that make an uncomfortable situation easier to accept. We selectively look for information that supports what we already want to believe. We convince ourselves that the painful reality isn't really as serious as it appears. But the more dangerous part can happen beneath conscious awareness. Our minds can automatically distort, filter, minimize, or even completely exclude information that conflicts with what we desperately want to believe. It's almost like putting blinders over your own perception. Imagine you're holding a losing position. The larger market trend is clearly moving against you. Your original setup has already been invalidated. The evidence is becoming increasingly obvious. But then the price makes one tiny move in your favor. Maybe the market rises a few points. Suddenly, your attention locks onto that small, favorable movement. You think, there it is. The reversal is starting. You ignore the larger trend. You ignore the warning signs. You ignore the information that contradicts your expectation. That tiny movement becomes emotionally significant because it gives you permission to continue believing what you want to believe. The market may continue falling immediately afterward, but your mind has already created a temporary story that protects you from accepting the loss. This is where the brain's incredible efficiency becomes dangerous in the trading environment. The same psychological mechanisms that evolved to protect us can work against us when we're dealing with markets. Your mind is trying to protect you from emotional pain, but in doing so, it can make crucial opportunities invisible. It can hide warning signs. It can distort the meaning of information. It can make you see what you want to see while filtering out what you need to see. And that can create catastrophic self-sabotage. The result becomes a vicious psychological cycle. A trader may begin with a carefree state of mind. They're relaxed, they're curious, they're willing to take opportunities, they aren't emotionally attached to individual outcomes. But after experiencing losses, that state begins to change. The trader starts moving into a prevent and avoid mode. Instead of thinking, what is the market showing me right now? They begin thinking, how can I make sure this doesn't hurt me again? That is a major psychological shift. The focus moves from opportunity to protection, from participation to avoidance, from possibility to fear. The trader begins developing a negative attitude toward uncertainty, and the more they learn to avoid emotional pain, the more rigid their expectations become. They start needing the market to behave in very specific ways. They want the setup to look exactly right. They want confirmation. They want the market to move according to their prediction. And when those expectations aren't fulfilled, the disappointment becomes even stronger. The more rigid the expectation, the more painful the violation of that expectation becomes. This creates a downward spiral. Pain creates avoidance. Avoidance creates rigid expectations. Rigid expectations create greater disappointment. Greater disappointment creates more fear. Fear creates more avoidance. And eventually the trader may become obsessed with learning because learning feels like progress, even though the actual psychological problem remains untouched. They keep consuming information, they keep searching for answers, they keep trying to become better analysts. But the learning isn't necessarily solving the real problem, it's simply becoming another form of protection. The trader may believe they're improving, when in reality, they're using knowledge to avoid confronting their distorted perspective. And until that underlying perspective is identified and corrected, the cycle continues. This also helps explain why traders can produce such dramatically different results even when they have access to similar information. Not every trader operates from the same psychological foundation. Douglas offers a useful framework by dividing traders into 3 broad categories: consistent winners, consistent losers, and the boom and busters. Let's take a closer look at each group. The first group is the smallest, the consistent winners. Douglas suggests that fewer than 10% of active traders fall into this category. Their equity curves, which represent the changing value of their trading accounts over time, generally show a steady upward progression. There are drawdowns, of course. There are losing trades. There are temporary periods when the account value declines. But those declines are relatively controlled compared with the overall upward trajectory. The important point is that these traders have not only learned how to make money, they have learned how to keep it. They have developed the psychological stability necessary to avoid being pulled into the destructive boom and bust cycle. They aren't immune to losing. They simply don't allow individual losses or winning streaks to completely alter their behavior. They understand that temporary drawdowns are part of the process. A losing trade doesn't destroy their confidence. A winning streak doesn't convince them that they're invincible. Their emotional responses remain relatively stable. Then we have the consistent losers. Douglas estimates that this group represents roughly 30 to 40% of active traders. Their equity curves tend to move in the opposite direction. Instead of showing a relatively stable upward trajectory, they experience repeated losses with occasional short-lived periods of success. They may make money for a while. They may even have a few impressive trades. But eventually, the same psychological patterns return. They repeat the same mistakes. They refuse to accept risk. They overreact to losses. They become emotionally attached to outcomes. They may hold losing positions for too long. They may take random trades. They may develop unrealistic beliefs about what the market should do. Some may even become psychologically attached to trading itself, creating patterns that resemble an addiction to the process. The occasional win keeps them involved. The occasional excitement keeps them engaged. But the underlying behavior prevents them from developing consistency. And then we have the largest category, the boom and busters. Douglas estimates that roughly 40 to 50% of active traders may fall into this group. These traders are particularly interesting because they have already demonstrated that they can make money. That's not their main problem. Their problem is that they don't know how to keep it. They may have profitable months. They may experience impressive winning streaks. They may look extremely successful for a period of time. But eventually, something happens. Their confidence changes. Their behavior changes. Their risk increases. Their discipline disappears. And the profits they've accumulated begin to disappear. Their equity curves look like roller coasters. A steep climb, then a dramatic fall. Another climb, another collapse. And the cycle continues. This is why the boom and buster category is so important. It demonstrates that knowing how to make money is not the same thing as knowing how to consistently manage yourself. A trader can have a profitable strategy and still destroy their results through psychological mistakes. Douglas provides examples of experienced traders who could go for weeks or even months without a losing day. Some could produce 15 or 20 winning trades in succession. From the outside, they appeared incredibly successful, but then something would change. One psychological shift could lead to an enormous loss. And this reveals a counterintuitive truth. Sometimes winning can be just as dangerous as losing. In fact, winning can create a psychological environment that is extremely vulnerable to self-destruction. The primary danger of winning is euphoria. Euphoria is a powerful emotional state. You feel unstoppable. You feel highly capable. Your confidence becomes extreme. After enough successful trades, the possibility of failure can begin to feel almost impossible. You start believing that you've figured the market out. You believe your analysis is exceptionally accurate. You may begin to think that your recent success proves something permanent about your ability, and that's when the danger begins. The trader starts relaxing the rules. They think, I don't really need my normal stop. They take another trade, then another. They increase their position size. They risk more than usual. They begin trading setups that don't meet their criteria. They tell themselves that because they're already profitable, they can afford to take additional risks. The rules that protected them during the winning streak suddenly feel unnecessary. The trader starts confusing a temporary sequence of favorable outcomes with permanent mastery. Eventually, this can produce what Douglas describes as a distorted sense of identification with the market itself. The trader begins behaving as though they are somehow one step ahead of everything. They feel as though they can't lose, but markets don't care about confidence. They don't care about your recent winning streak. One small movement against an oversized position can completely change the psychological situation. If the position is large enough, even a tiny price movement can create a significant financial loss. And when the trader is psychologically unprepared for that possibility, something can happen that Douglas describes as a kind of mental freeze. They stare at the screen. They know they should act. They know the position is becoming dangerous, but they can't move. They can't close it. They can't make a decision. The fear becomes so intense that action itself becomes difficult. And by the time they finally respond, the loss may have become dramatically larger. Then comes the familiar reaction. The market did this to me. The blame returns. The frustration returns. The trader becomes determined to understand what went wrong. So they learn more, they analyze more, they build confidence again. Eventually they reach another winning streak. The confidence returns. The euphoria returns. The risk increases again. And then another crash. Learn more. Gain confidence, become euphoric. Take greater risks. Crash. Repeat. That's the boom and bust cycle. But euphoria isn't the only danger. There is another phenomenon that can be even more mysterious: self-sabotage. Sometimes a trader's losses don't come from a lack of knowledge or an obvious emotional reaction. They come from deeply rooted internal conflicts. At a subconscious level, the trader may have unresolved beliefs about money, success, worthiness, or deserving to win. They may intellectually want financial success while emotionally feeling uncomfortable with the identity associated with having it. This conflict can manifest through strange and seemingly inexplicable behavior. A trader might intend to buy but accidentally enter a sell order. They might become distracted at the exact moment a perfect setup appears. They might suddenly walk away from the screen during an important opportunity. They might repeatedly miss trades that perfectly match their strategy. They may hesitate for reasons they can't fully explain. And afterward, they may look at the chart and think, why didn't I take that trade? The setup was obvious, the conditions were exactly right, the system gave the signal, yet somehow they weren't there. Douglas describes this as hitting an invisible psychological barrier. The trader may reach a particular level of account growth and then experience a sudden dramatic drawdown. Perhaps they reach a balance they have never reached before. Maybe they cross a psychological threshold, and then, almost mysteriously, their behavior changes. They begin taking unnecessary risks. They stop following their rules. They make strange decisions. The account drops, and they tell themselves it was simply bad luck. But Douglas argues that this may represent something deeper. There can be a psychological glass ceiling created by unresolved beliefs about money, success, and self-worth. The trader may subconsciously return to a familiar financial level because that level feels psychologically safer. They may consciously want more money, while subconsciously resisting what having more money represents. This creates a conflict between conscious goals and subconscious beliefs. And because the conflict operates below conscious awareness, the trader may interpret the resulting losses as random bad luck. But the pattern keeps repeating. They rise, they hit the threshold, they fall, they recover, they rise again, they hit the threshold again, and they fall again. It's almost like climbing a mountain and then, without realizing it, cutting your own safety rope just before reaching the summit. This is why winning itself can become dangerous if the internal game hasn't been mastered. Making money doesn't automatically prove that your psychology is healthy. Sometimes success exposes psychological issues that were invisible during periods of struggle. The market becomes a mirror. It doesn't create your attitude, it reflects it. If you feel confident, that confidence comes from your internal beliefs about your ability to handle uncertainty. If you feel angry, that anger reflects your interpretation of what happened. If you feel afraid, that fear comes from the meaning you've assigned to the situation. The market is simply providing information. Your mind decides what that information means. And this is why responsibility is so important. If you refuse to accept responsibility for your reactions, you remain trapped in the cycle of pain and dissatisfaction. You keep searching for external explanations. You keep trying to fix the market. You keep gathering knowledge in the wrong way. It lives in your mind. Consistency is fundamentally a state of mind. And this leads to another fascinating contradiction. Trading can feel incredibly easy when you're winning. Most traders have experienced that moment. Everything seems obvious. The setup appears. You enter. The market moves immediately in your favor. Money seems to appear with almost no effort. You think, this is easy. You may even wonder why everyone doesn't do it. You start believing that you've finally figured everything out, but then the conditions change. The next trade doesn't work. Then another one doesn't work. You begin hesitating. You start questioning yourself. The same process that felt effortless suddenly becomes extremely difficult. And that's the difference between something feeling easy and something actually being easy. The market can temporarily create the feeling that trading is effortless. But sustainable ease doesn't come from favorable external conditions. It comes from an internal state that remains stable regardless of those conditions. If your confidence depends on the market behaving exactly as you expect, then your confidence will disappear as soon as the market surprises you. If your happiness depends on winning trades, losses will destroy your emotional stability. If your confidence depends on being right, uncertainty will constantly threaten your identity. The same principle applies beyond trading. You can't permanently depend on external circumstances to make you feel successful, confident, or happy. External conditions change, markets change, people change, opportunities change. Your internal stability has to come from somewhere deeper. Consistent traders embody consistency. They don't constantly struggle to become consistent in every individual moment. Consistency has become part of how they operate. It's a natural expression of their psychological state. For them, the best trades feel easy. They are fully present. They aren't trapped in the past. They aren't trying to predict every future movement. They aren't overwhelmed by fear. They aren't fighting themselves. They're simply responding to the opportunity in front of them. Everything they've learned is available when they need it. Nothing is being blocked by unnecessary fear or doubt. Their actions feel effortless because there isn't an internal battle taking place. That's what flow looks like. And this reveals another paradox. The moment you start desperately trying to be consistent, you may actually be creating resistance. Trying implies effort. Trying implies struggle. Trying implies that you're attempting to force something to happen. In trading, that can create the subtle feeling that you need the market to give you something. You need this trade to work. You need to recover the previous loss. You need to make your daily target. You need to prove that your analysis was correct. You need the market to validate you. And once those needs appear, you're no longer simply responding to the opportunity. You're trying to extract a specific outcome from the market. The most successful traders operate differently. They make themselves available to whatever the market is offering at that particular moment. If an opportunity fits their criteria, they act. If it doesn't, they wait. If the trade wins, they accept the result. If it loses, they accept the result. There is no need to force anything. They don't demand that the market conform to their expectations. And whenever the market inevitably fails to behave according to our expectations, the mind's psychological defense mechanisms can immediately activate. The walls go up. The brain begins protecting itself from emotional pain. Threatening information may be ignored. Contradictory evidence may be minimized. Instead of using knowledge to identify opportunities, you use it to protect yourself from perceived danger. You aren't learning to participate more effectively. You're learning to avoid being hurt. And that distinction can completely change the outcome of your trading. One of the most painful experiences for many traders isn't actually losing money. It's watching a profitable opportunity disappear without taking advantage of it. It's leaving money on the table. Most traders know the feeling. You see the setup. You hesitate. The market moves exactly as expected. The move becomes enormous and you sit there watching it happen without you. That one can hurt more than a normal loss. Why? Because when you lose money, you can often create an external explanation. The market reversed. The news changed. The volatility increased. Something unexpected happened. You can tell yourself there was a reason. But when you leave money on the table, the situation feels different. The market actually gave you the opportunity. The setup appeared, the move happened, and you weren't able to act. There is no obvious external force to blame. The pain points directly back at you. And that's difficult to rationalize. You have to confront your hesitation. You have to confront your fear. You have to confront the fact that you were psychologically unable to execute when the opportunity was available. This is why taking responsibility becomes the cornerstone of a winning attitude. It is the first major step. You stop expecting the market to give you anything. You stop believing the market owes you profits. You stop fighting the market. And ultimately, you stop fighting yourself. You accept that the market will do whatever it is going to do. Your responsibility is to determine how you respond. You define your risk. You follow your process. You accept the outcome. You learn. You adjust when necessary. And you continue. Douglas suggests that once you genuinely make this shift, you begin seeing much more clearly what you actually need to learn next. Instead of being distracted by blame, frustration, or the endless search for certainty, you can finally identify the real areas where development is required. Hindsight always feels perfectly clear, especially when fear has prevented you from seeing what was actually happening in the moment. And this brings us back to the central solution to persistent fear and inconsistency. You must fundamentally accept the risk that is built into trading. You have to train yourself to think about trading in a way that makes you less vulnerable to the conscious and subconscious mental processes that cause you to hide, distort, filter, or selectively interpret information. The threat of emotional pain creates fear, and according to Douglas, fear lies behind the overwhelming majority of trading errors. Accepting risk therefore means being willing to accept the consequences of your trades without allowing those possible outcomes to create emotional discomfort or fear. It means becoming genuinely comfortable with uncertainty and being okay with whatever the individual outcome happens to be. When you reach that point, the market is finally allowed to unfold on its own terms. You become more available to recognize opportunities and act on them without trying to force a particular result. You can simply observe what the market is doing, respond according to your rules, and remain satisfied regardless of what the market ultimately decides to do. But there is a difficult question hiding underneath all of this. How can you genuinely accept risk without feeling uncomfortable when your own perception of risk is what creates that discomfort in the first place? It almost sounds like a psychological catch-22. That's exactly the challenge, and Douglas addresses it with a powerful analogy involving snakes. He once worked with a client who was absolutely terrified of snakes. The man couldn't even look at one without experiencing an intense fear response. Yet his 3-year-old daughter had a completely different reaction when she encountered a snake for the first time. Instead of being terrified, she was fascinated by it. And the important difference was that the young girl had no previous painful experience with snakes and no established belief system telling her that snakes were something she needed to fear. Her response was immediate, natural, and unfiltered curiosity. There was no psychological history attached to the object in front of her. That distinction is extremely important for traders. Many people assume that highly successful professionals experience exactly the same fear as everyone else, but simply possess enough courage, discipline, or emotional strength to push through it. They imagine the professional trader as someone who is constantly afraid but has learned to grit their teeth, control their emotions, and act anyway. Douglas argues that this picture is fundamentally wrong. The professional trader who has genuinely accepted risk does not perceive market information in the same threatening way. As he explains, when you accept risk in the way experienced professionals do, you no longer interpret whatever the market can do as something inherently threatening. And when there is no perceived threat, there is no fear. When there is no fear, you no longer need extraordinary courage. You don't need nerves of steel. You don't need to constantly force yourself through emotional resistance. You don't need to rely on exhausting self-control every time you place a trade. The struggle becomes unnecessary because the psychological source of the struggle has been removed. That leads to a profound realization. The goal isn't simply to suppress fear or become better at hiding it. The goal is to eliminate the psychological conditions that create the fear in the first place by changing how you perceive uncertainty and risk. This is where the real debugging of your mental software begins. The transformation starts by consciously reorganizing your internal mental environment. The ultimate objective is to remove the emotional threat of pain from market information and develop a consistently calm, open, and relatively carefree state of mind. Douglas compares our mental state and perspective to computer software. Think about how a computer program works. A system can be incredibly sophisticated and function perfectly, but one flawed line of code, one incorrect character, or one misplaced instruction can cause the entire system to behave unpredictably. The same principle can apply to your beliefs. One deeply flawed belief about money, risk, being right, losing, or success can influence the way you interpret an enormous amount of information. That is why identifying and correcting these psychological bugs becomes such an important part of developing consistency. But there's another distinction that makes this process even more interesting. Awareness isn't necessarily the same thing as belief. Knowing something intellectually doesn't mean you have internalized it deeply enough for that knowledge to automatically influence your behavior. You can understand an idea perfectly on an intellectual level and still behave as though you don't believe it at all. Return to the man who was afraid of snakes. He might intellectually understand that certain snakes are harmless. He may know the statistics. He may know that the particular snake in front of him isn't necessarily dangerous. But none of that intellectual information automatically eliminates the emotional reaction. His body can still freeze. His heart can still race. His mind can still demand that he get away. So there is a difference between knowing something and functionally believing it. And that difference is enormously important in trading. Real transformation doesn't happen simply because you add more information to your mental database. It happens when the underlying psychological software is actually rewritten. And to rewrite that software, you first need to understand how perception itself works. Consider how you experience the world around you. Everything in your environment is constantly generating information. Sounds, movements, colors, prices, words, patterns, events, and countless other signals are continually reaching your senses. But you don't consciously process all of that information. Your internal structure determines what you notice and what you ignore. Your beliefs, values, memories, experiences, and accumulated knowledge act like a filter. They determine what becomes meaningful and what remains invisible. Douglas illustrates this beautifully with something as simple as a price chart. Imagine seeing a trading chart for the very first time. At first, it may look completely meaningless, just lines moving up and down, random squiggles, numbers changing. Nothing particularly obvious. You don't yet have the internal framework necessary to interpret what you're seeing, but then you learn. You study price action. You understand support and resistance. You learn about trends, patterns, volatility, momentum, and market structure. Suddenly, the same chart begins to look completely different. You can see distinctions that were previously invisible. You recognize patterns. You identify potential opportunities. You notice changes in behavior. The external information didn't necessarily change. Your internal framework changed. And because your internal framework changed, your perception changed. This is why the market itself isn't inherently threatening. The market generates information. Your psychological framework determines how you interpret that information. Douglas therefore encourages traders to ask themselves a powerful question whenever they experience fear. Is the information itself actually threatening, or am I experiencing the effect of my own psychological state being reflected back through the market? That's a powerful question because it shifts responsibility back toward you. The market isn't necessarily doing something to you, it is showing you information. Your mind is deciding what that information means. In that sense, the market becomes a mirror. Imagine a trader who has just experienced several consecutive losses. A completely valid trading signal appears. The setup meets the trader's criteria. The same signal that would normally represent an opportunity now feels dangerous. The trader hesitates. They search for additional confirmation. They find contradictory information. They wait. The market moves. The opportunity disappears. And afterward, they feel frustrated because they realize they missed a trade that would have worked. Now compare that with a trader who has just experienced several consecutive wins. The exact same market signal appears, but this time, the trader sees opportunity immediately. They may even feel unusually confident. Perhaps they increase their position size. Perhaps they take more risk than their normal rules allow. The signal hasn't fundamentally changed. The psychological state of the trader has changed. Why does this happen? Because the human mind is constantly and automatically connecting external information with internal information. We see something outside ourselves and immediately associate it with something we already know. That association often happens without conscious awareness. The current moment begins to feel similar to something from the past. A current loss reminds us of previous losses. A current winning setup reminds us of previous wins. A current uncertainty reminds us of previous pain. And those associations can create fear, excitement, confidence, or euphoria before we've even consciously analyzed what is happening. This is why developing the ability to perceive the market's opportunity flow without becoming controlled by fear or overconfidence requires conscious management of that association process. You have to become flexible in your expectations while remaining rigid in your rules. That sounds contradictory, but it is actually one of the most important principles in Douglas's framework. You need rigid rules because rules create structure. They define your risk. They prevent emotional improvisation. They help build self-trust. They provide boundaries in an environment that offers almost no external boundaries. But at the same time, you need flexible expectations. You cannot demand that the market produce a specific outcome. You cannot assume that because one pattern worked previously, it must work again in exactly the same way. You have to remain open to what the market is actually doing. The typical trader often does the opposite. They are flexible with their rules and rigid with their expectations. They bend their stop. They delay their exit. They take trades that don't meet their criteria. They make exceptions when emotions become strong. But when it comes to the market's behavior, they become incredibly rigid. They expect the price to move where they predicted. They expect the pattern to work. They expect the market to validate them. That combination is psychologically destructive. Douglas therefore encourages the development of a genuinely objective relationship with uncertainty. One of the most interesting observations he makes is that many traders allow their perception of risk to be heavily influenced by the results of their most recent 2 or 3 trades. If they have just lost, the next opportunity feels dangerous. If they have just won, the next opportunity feels easier. Their emotional state changes the meaning of the market. That's an extremely narrow and biased perspective. The best traders operate differently. They aren't heavily influenced by their most recent outcomes. A recent loss doesn't automatically make the next trade look worse. A recent win doesn't automatically make the next trade look better. They deliberately avoid allowing past outcomes to dictate their perception of the present moment. This is where the uncertainty principle becomes extremely important. The trader understands that the outcome of the next trade is uncertain. They know they have an edge, they know their risk, they know their process, but they don't pretend to know exactly what will happen next. That belief in uncertainty is what makes fearless trading possible. It allows the trader to remain objective. It allows them to stay present. It allows them to recognize the opportunity flow without constantly comparing the current moment with the past. And eventually, it creates the psychological conditions necessary for entering the zone. The professional trader doesn't simply repeat the phrase, "anything can happen." They genuinely believe it. Their belief in uncertainty is strong enough to prevent their mind from automatically forcing the present situation into the framework of previous experiences. Because they aren't trying to predict the exact outcome, their expectations remain flexible. They aren't demanding certainty. They aren't demanding confirmation. They aren't demanding that the market prove them right. Instead, they make themselves available. They remain open to discovering what happens next. They recognize that their own perception is limited. They understand that no matter how much experience they have, they cannot know everything that is happening inside the minds of every participant in the market. So rather than assuming they already know, they stay curious, they observe, they respond, they adapt. And this is particularly important when you have a fear of being wrong. If you're emotionally attached to being right, your mind can literally become blind to information that contradicts your position. You may see a trend moving against you, but refuse to recognize it because accepting that information would force you to admit that your original decision was wrong. The information becomes psychologically painful, so the mind protects itself by filtering it out. This is a powerful form of self-preservation that becomes self-destruction in the trading environment. Your mind is trying to protect your emotional identity, but the price of that protection may be financial loss. That's why true objectivity is so difficult. We naturally want reality to confirm what we already believe. We want our decisions to be correct. We want our predictions to work. We want to feel competent. And when information threatens that identity, the mind can unconsciously reject the information, even when doing so costs us money. The solution is to separate what you know from what you don't know. You can know that you have a specific edge. You can know the variables that define your setup. You can know where your risk lies. You can know what conditions justify entering a trade. But you cannot know with certainty how that particular trade will unfold. You cannot know the exact sequence of price movements. You cannot know which trader will suddenly change their position. You cannot know which unexpected event may influence the market. That is the unknown. And accepting both sides of that equation is essential. You know what you know. You accept what you don't know. You remain open to the outcome. That open-mindedness creates a dynamic relationship with the market. Instead of forcing your interpretation onto the market, you allow the market to continuously provide new information. And this is what creates the possibility of entering the zone. In the zone, the separation between the trader and the market can feel almost non-existent. Your perception becomes extremely sensitive. You aren't consciously struggling through every decision. You aren't constantly debating whether to trust yourself. You are simply responding to what is happening. It's almost like watching a flock of birds suddenly change direction, or a school of fish move together with perfect synchronization. There is no visible commander giving instructions. The movement simply emerges from the interaction of countless individual elements. Douglas uses this idea to describe a state where the trader feels deeply synchronized with the opportunity flow of the market. But reaching that state requires overcoming two major psychological obstacles. The first is keeping your attention focused on the present moment. Not what happened 5 trades ago, not what might happen 10 minutes from now, not what you hope will happen, not what you fear will happen, just what is happening now. You have to remain open to the market as it actually is, rather than projecting your past experiences or future expectations onto it. The second challenge is reconciling the conflict between rational and intuitive thinking. The rational mind depends heavily on what it already knows. It wants explanations, it wants evidence, it wants logical sequences, it wants to understand why something should happen. But creative and intuitive thinking can operate differently. Sometimes an insight appears before you can logically explain it. A pattern becomes obvious. You sense a shift. You recognize something without immediately being able to articulate exactly why. The rational mind can become suspicious of this kind of information. It may start questioning the intuition. Then another thought appears, then another. Suddenly your consciousness is filled with competing arguments. The internal debate begins. And once that happens, the effortless state of the zone can disappear. So the deeper lesson isn't simply that traders need more indicators, more data, or more sophisticated analytical tools. The deeper lesson is that successful trading requires learning an entirely different way of interacting with uncertainty. Many traders mistakenly believe that being a successful trader is primarily the same thing as being an excellent market analyst. They assume that the person who understands the market best will automatically trade it best. But the two abilities are not identical. You can be brilliant at analyzing markets and still be terrible at executing trades. You can recognize patterns accurately and still hesitate. You can predict movements correctly and still fail to capitalize on them. You can possess enormous amounts of knowledge and still lose money because your psychological responses prevent you from applying that knowledge consistently. The market has its own unique psychological characteristics, and to operate effectively inside that environment, the trader has to adapt. Many people resist that adaptation for two major reasons. The first is that a single winning trade requires almost no demonstrable skill. Anyone can get lucky. Someone with no experience can randomly enter a position and make money. A beginner can make an excellent trade by accident. And because winning can happen without skill, it may take years of inconsistent results before a trader finally understands that occasional success proves very little. The second reason is that trading often happens from a familiar environment. You may sit at home. You may be using a computer. You may be analyzing charts from a comfortable room. Nothing about the physical environment necessarily tells you that you're entering a psychologically specialized profession. So you may assume, I'm intelligent, I'm successful in other areas, I understand business, therefore I should naturally be successful at trading. But trading requires a different psychological adaptation. Knowing that intellectually isn't enough. You have to internalize it. And this brings us to what Douglas describes as the one trader principle. Price movement ultimately results from opposing beliefs. Some traders believe the price will rise, others believe it will fall. And because there are countless participants, each with different information, goals, time horizons, fears, strategies, and expectations, the possibilities become almost limitless. It only takes one other participant to change the balance. Douglas gives a memorable example involving a technical analyst who was extremely confident about a specific support level in soybeans. The analyst was convinced that the level represented the low of the day. Then the firm's experienced chairman called a broker and instructed the broker to sell 2 million bushels of soybeans at the market. The result was immediate. Within seconds, the market plunged dramatically. The chairman then essentially asked the analyst where he believed the market was supposed to stop. The lesson was brutal, but clear. No matter how confident you are in your analysis, another participant can introduce information or buying and selling pressure that completely changes the situation. Your edge doesn't guarantee the outcome, it only gives you a probability. And that means every trade you make has an uncertain outcome. Period. The most successful traders don't merely acknowledge that intellectually. They build their entire behavior around that reality. They consistently perform 3 critical actions. First, they define their risk before entering every trade. Second, they cut losses without hesitation when their predetermined conditions are reached. Third, they follow a systematic money management process for taking profits. These actions may sound simple, but they are psychologically powerful. They prevent uncertainty from becoming emotional chaos. They establish boundaries before emotions become involved. They protect the trader from both financial and psychological destruction. Yet many traders fail to follow these principles precisely because they still believe they know what will happen next. They think, this trade is different. They think, this setup is too good to fail. They think, I know what's coming. And that illusion of certainty is exactly what puts them at risk. Everything eventually comes back to beliefs. Our beliefs are powerful internal forces. They influence how we interpret market information. They influence what we notice. They influence what we ignore. They influence how we respond. And they influence whether we follow our rules when pressure increases. Among all the beliefs Douglas discusses, perhaps the most important is the belief that anything can happen. This belief expands your perception. It trains your mind to think in probabilities. It prevents you from automatically filtering information simply because that information feels uncomfortable. It reduces the psychological need to be right. It weakens the fear of losing. It reduces the fear of missing out. And it helps eliminate the emotional pain associated with leaving money on the table. It becomes the foundation upon which the other successful trading attitudes can be built. But knowing that anything can happen isn't enough. The real challenge is learning how to internalize that belief so deeply that it influences your behavior automatically. And this is where Douglas introduces one of his most useful comparisons: the casino. Professional gamblers and casinos understand uncertainty differently from most struggling traders. They don't know what the next roulette spin will produce. They don't know which card will be dealt next. They don't know the result of the next individual event, but they don't need to know. They understand that their advantage exists across a sufficiently large sample size. If the mathematical edge is in their favor and they participate consistently enough, the probabilities can work for them over time. They don't emotionally attach themselves to each individual event. One loss isn't a crisis. One win isn't proof of genius. Each event is simply one event inside a much larger sample. A trader with a legitimate edge needs to think in the same way. The known variables are the rules of the trading system and the conditions that define the edge. The unknown variables include everything else. Which traders are waiting? Which participants will change their minds? Who will suddenly enter? Who will suddenly exit? What unexpected information may appear? What order flow may emerge? Those unknown factors create the random distribution between wins and losses. And this randomness exists even when the edge is real. That leads to another crucial idea. Every market moment is unique. A chart pattern can look almost identical to something you've seen before, but the underlying conditions are never perfectly identical. The participants are different. Their beliefs are different. Their positions are different. Their intentions are different. The broader environment may be different. Even when the visible pattern looks familiar, the underlying psychological dynamics are never exactly the same. So every present moment is genuinely new. Every setup is its own event. Every trade has its own outcome. And because each moment is unique, anything can happen. The human mind naturally struggles with this. We tend to categorize. We recognize familiar patterns. We compare the present with the past. We try to predict what comes next based on what happened before. That ability is useful in many areas of life. But in trading, it can become dangerous if we allow familiarity to create false certainty. Douglas therefore emphasizes the need to deliberately train your mind to recognize the uniqueness of each moment. And that brings us to a deeper psychological conflict. How do you reconcile the human desire for certainty with the undeniable randomness of market outcomes? This is one of the fundamental tensions in trading. Unsuccessful traders often become obsessed with analysis because analysis gives them the feeling that certainty might eventually be possible. They search for another indicator, another pattern, another confirmation, another piece of data, another strategy. They hope that enough information will finally eliminate uncertainty. But uncertainty cannot be eliminated, and the desire to be right on every trade is fundamentally incompatible with a probabilistic environment. You cannot win every trade. You don't need to. The goal is not perfect prediction. The goal is consistent execution of an edge across a sufficiently large sample. To help develop that mindset, Douglas presents 5 fundamental truths. These truths form the psychological foundation for consistent trading. The first fundamental truth is simple: anything can happen. There are always unknown forces operating in the market. Other traders are making decisions. Those decisions can change the balance at any moment. One participant can act in a way that completely alters the outcome of your trade. Therefore, expecting that anything can happen actually aligns your expectations with reality. When you truly expect uncertainty, unexpected outcomes don't feel like betrayals. They don't automatically create emotional pain. You aren't shocked when a winning setup loses. You aren't emotionally devastated when the market moves without you. You aren't forced into fear simply because something unexpected occurred. The second fundamental truth is that you don't need to know what is going to happen next in order to make money. This can initially feel strange because traditional thinking often tells us that successful people know what will happen. But trading doesn't work that way. You don't need to predict the outcome of each individual event. You need to identify an edge and execute it consistently. There will naturally be a random distribution of wins and losses. That's the nature of a probability-based system. Once you understand this, winning and losing stop carrying the same emotional weight. Being right doesn't become a measure of your intelligence. Being wrong doesn't become a threat to your identity. A loss becomes simply one possible outcome. The third fundamental truth is that there is a random distribution between wins and losses for any given set of variables that defines an edge. This means that even when you have a legitimate advantage, you cannot know which individual trade will win. A loss doesn't automatically mean the edge has stopped working. A win doesn't automatically prove that your analysis was perfect. Over a sufficiently large sample, however, the statistical tendencies of the edge can begin to reveal themselves. This changes your relationship with the next trade. Instead of fearing it, you can simply execute it. You don't need to know whether this specific trade will be the winner. You only need to know that it fits your edge. The fourth fundamental truth is that an edge is simply an indication that one outcome has a higher probability than another. That's all. It isn't certainty, it isn't a guarantee, it isn't a promise, it's a statistical advantage. And once you understand that, your responsibility becomes much simpler. Define the edge, define your risk, take the trade, accept the outcome. There is no need to spend endless energy trying to predict the exact result of an individual trade. If your edge is legitimate, your job is to execute it. Everything else can become noise. And the fifth fundamental truth is that every moment in the market is unique. This may sound obvious, but the psychological implication is enormous. Your mind automatically wants to compare the present with the past. It wants to say, "I've seen this before," but you haven't seen this exact moment before. The participants are different. The circumstances are different. The intentions are different. The information available to everyone is different. You must therefore consciously interrupt the automatic tendency to associate the current moment with previous experiences. You have to see the market as it is right now, fresh, unfiltered, without forcing it into an old mental category. Only when you're genuinely comfortable with not knowing what happens next can you become fully available to the market. Instead of telling the market what you think it should do, you allow the market to show you what it is actually doing. And this brings us to the importance of expectations. Expectations are not automatically harmful, but rigid expectations are. The more specific and inflexible your expectations become, the more vulnerable you become to emotional pain when reality doesn't match them. Our minds naturally project what we believe to be true into the future. We imagine the outcome. We build a story. We begin emotionally preparing for that story to happen. Then reality takes a different path, and suddenly we feel angry, disappointed, frustrated, betrayed. We say, "The market let me down." But the market didn't make a promise. The expectation existed inside us. And when the expectation wasn't fulfilled, the psychological pain activated our natural defense mechanisms. Consciously, we may rationalize, we may justify, we may create excuses. We may tell ourselves stories that make the outcome easier to accept. Subconsciously, we may block conflicting information. We may narrow our focus. We may distort what we're seeing. We may selectively notice evidence that supports our position. In other words, we protect ourselves from the truth. This is why price movements themselves are fundamentally neutral. A tick upward isn't inherently good. A tick downward isn't inherently bad. The meaning comes from the trader's interpretation. The same price movement can create excitement for one person and fear for another. It depends on the psychological framework through which the information is being processed. Douglas illustrates this through what he calls the observer's advantage. When you're simply watching the market without intending to take a position, you can often see it with remarkable clarity. Why? Because nothing is at stake. There is no money on the line. There is no specific expectation. There is no need for the market to validate you. Because there is no emotional attachment, your perception remains relatively open. You can observe without filtering the information through fear. You can see possibilities without immediately needing one of them to happen. This observer's state of mind provides a glimpse of the objectivity that successful traders need while actually participating. And this naturally leads us to the mechanical stage of trader development. At this point, the work becomes extremely practical. Douglas describes three broad stages of development. The first is the mechanical stage. This is the foundation. Here, the trader builds unwavering self-trust. They learn to execute a predetermined system consistently. They deliberately train their mind to think in probabilities. There is no need to spend endless energy trying to predict the exact result of an individual trade. If your edge is legitimate, your job is to execute it. Everything else can become noise. And the fifth fundamental truth is that every moment in the market is unique. This may sound obvious, but the psychological implication is enormous. Your mind automatically wants to compare the present with the past. It wants to say, "I've seen this before." But you haven't seen this exact moment before. The participants are different. The circumstances are different. The intentions are different. The information available to everyone is different. You must therefore consciously interrupt the automatic tendency to associate the current moment with previous experiences. You have to see the market as it is right now, fresh, unfiltered, without forcing it into an old mental category. Only when you're genuinely comfortable with not knowing what happens next can you become fully available to the market. Instead of telling the market what you think it should do, you allow the market to show you what it is actually doing. And this brings us to the importance of expectations. Expectations are not automatically harmful, but rigid expectations are. The more specific and inflexible your expectations become, the more vulnerable you become to emotional pain when reality doesn't match them. Our minds naturally project what we believe to be true into the future. We imagine the outcome. We build a story. We begin emotionally preparing for that story to happen. Then reality takes a different path. And suddenly we feel angry, disappointed, frustrated, betrayed. We say, "The market let me down." But the market didn't make a promise. The expectation existed inside us. And when the expectation wasn't fulfilled, the psychological pain activated our natural defense mechanisms. Consciously, we may rationalize. We may justify. We may create excuses. We may tell ourselves stories that make the outcome easier to accept. Subconsciously, we may block conflicting information. We may narrow our focus. We may distort what we're seeing. We may selectively notice evidence that supports our position. In other words, we protect ourselves from the truth. This is why price movements themselves are fundamentally neutral. A tick upward isn't inherently good. A tick downward isn't inherently bad. The meaning comes from the trader's interpretation. The same price movement can create excitement for one person and fear for another. It depends on the psychological framework through which the information is being processed. Douglas illustrates this through what he calls the observer's advantage. When you're simply watching the market without intending to take a position, you can often see it with remarkable clarity. Why? Because nothing is at stake. There is no money on the line. There is no specific expectation. There is no need for the market to validate you. Because there is no emotional attachment, your perception remains relatively open. You can observe without filtering the information through fear. You can see possibilities without immediately needing one of them to happen. This observer's state of mind provides a glimpse of the objectivity that successful traders need while actually participating. And this naturally leads us to the mechanical stage of trader development. At this point, the work becomes extremely practical. Douglas describes 3 broad stages of development. The first is the mechanical stage. This is the foundation. Here, the trader builds unwavering self-trust. They learn to execute a predetermined system consistently. They deliberately train their mind to think in probabilities. They internalize the 5 fundamental truths, and they begin developing an unshakable belief in their ability to operate consistently. The second stage is the subjective stage. Here, the trader begins using accumulated market knowledge with greater freedom. But greater freedom also requires greater self-awareness. The trader must continuously monitor themselves for self-evaluation errors, emotional reactions, and subconscious biases that may begin influencing decisions. The final stage is the intuitive stage. This is the most advanced and difficult stage to describe. Trading becomes more spontaneous. The trader can respond intuitively to information without needing to consciously process every element. But reaching this stage requires the rational mind to develop enough trust in creative and intuitive information. Those flashes of insight, those subtle recognitions, those moments when something feels clear before you can completely explain it logically. However, you cannot simply skip to this stage. You have to earn it. The mechanical stage comes first because it creates the psychological foundation upon which everything else depends. The goal of the mechanical stage is to transform your internal identity until you can genuinely operate from the belief, I am a consistently successful trader. And that transformation requires what Douglas describes as the 7 principles of consistency. The first principle is, I objectively identify my edges. You need to know exactly what your advantage is, not what you hope is an advantage, not what someone online claims is an advantage, your actual, clearly defined edge. The second principle is, I predefine the risk of every trade before entering. You must know your risk before the emotional pressure of the trade begins. The third principle is, I completely accept the risk or I am willing to let go of the trade. If you cannot accept the risk, you shouldn't enter. The fourth principle is, I act on my edges without reservation or hesitation. No second guessing. No emotional debate once the conditions are met. The fifth principle is, I pay myself as the market makes money available to me. Profits need to be managed systematically rather than emotionally. The sixth principle is, I continually monitor my susceptibility to making errors. You must remain aware of your own psychological tendencies. And the seventh principle is, I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. This is where commitment becomes non-negotiable. Once you understand why the principles exist, you don't casually abandon them when emotions become strong. But how do you actually put all of this into practice? Douglas recommends a mechanical exercise designed specifically to build self-trust. First, select an actively traded and sufficiently liquid market where you can trade a consistent position size. The specific market matters less than the structure of the exercise. The purpose is not to discover the world's greatest trading system. The purpose is to train your mind. Next, choose a clearly defined set of market variables that creates your edge. The system can be mathematical, it can be mechanical, it can be visual. But the rules should be precise enough that the entry and exit decisions don't require subjective interpretation. And here's an important point. The system doesn't need to be spectacular. It doesn't need to produce enormous profits. It's a radical shift in perspective. Instead of fighting the market, you learn to work with the nature of the market. Instead of demanding certainty, you accept uncertainty. Instead of trying to predict every outcome, you focus on executing your edge. Instead of blaming external conditions, you examine your own responses. And instead of treating every individual trade as a verdict on your intelligence or ability, you see it as one event inside a much larger probability distribution. The deeper lesson goes far beyond trading. The mental habits that create problems in the market are often the same habits that create problems elsewhere in life. Our need for certainty, our fear of being wrong, our tendency to avoid pain, our desire to control outcomes, our attachment to past experiences, our habit of interpreting neutral events emotionally. These tendencies may be useful in some environments, but they can become limitations when we enter situations where uncertainty is unavoidable. And the encouraging part is that psychological patterns are not necessarily permanent. They can be examined, they can be challenged, they can be retrained, they can be replaced through deliberate practice. That's what Douglas means when he compares the mind to software. You may have inherited certain psychological programs through experience, education, family, culture, success, failure, and repeated emotional conditioning. But you don't have to remain permanently controlled by them. You can become aware of the code. You can identify the bugs. You can change the patterns. And over time, you can build a mental framework that is better suited to the environment you're operating in. That is why becoming a consistent trader is ultimately a form of self-mastery. It requires self-awareness. It requires humility. It requires the willingness to question assumptions that once felt completely true. It requires repeated practice, and it requires the courage to look honestly at your own behavior without turning that observation into self-judgment. The market becomes a powerful teacher because it constantly exposes the gap between what you say you believe and how you actually behave under pressure. You may say you accept risk and then panic when a trade moves against you. You may say you think probabilistically and then become emotionally attached to one prediction. You may say you follow your rules and then abandon them after a winning streak. You may say you are disciplined and then discover that your behavior changes when money is involved. The market exposes those contradictions. And yes, sometimes it can be an extremely expensive teacher, but it can also be one of the most powerful environments for learning about yourself. Because every reaction provides information. Every hesitation can reveal a belief. Every impulsive decision can reveal a psychological pattern. Every repeated mistake can point towards something that needs to change. And eventually, the objective isn't simply to become better at predicting markets. It's to become better at managing yourself inside uncertainty. That skill has applications far beyond trading. It can influence how you make decisions, how you handle failure, how you respond to uncertainty, how you manage opportunities, how you deal with criticism, how you approach relationships, how you respond when reality doesn't match your expectations. In that sense, the principles of trading in the zone are ultimately principles of psychological freedom. You stop demanding that reality behave according to your expectations. You stop interpreting uncertainty as a threat. You stop believing that being wrong means something is wrong with you. You stop treating every outcome as a personal judgment, and you become more capable of responding to reality as it actually is. So here's the final thought I want to leave you with. If your trading results really are a reflection of your internal state, as Douglas suggests, what might the difficult areas of your life be reflecting back to you? Where do you repeatedly experience fear? Where do you keep trying to control outcomes you cannot control? Where do you become rigid in your expectations? Where do you avoid information because accepting it would be painful? Where do you blame external circumstances instead of examining your own response? And perhaps most importantly, what would happen if you began treating those patterns the same way a successful trader treats uncertainty? Observe them, accept them, learn from them, change the behavior, repeat the process. Because the deeper lesson isn't simply that you need to master the market, it's that you need to master the mind that interacts with the market. And once you understand that, the entire idea of success begins to look different. You don't need perfect certainty. You don't need perfect prediction. You don't need to win every time. You don't even need to eliminate fear completely. You need to develop a psychological structure that allows you to act effectively even when certainty is impossible. You need to know your edge. You need to define your risk. You need to accept the outcome. You need to remain open to what you don't know. And you need to trust yourself enough to follow your process consistently. That's where real consistency begins. Not in the market, inside you. Until next time, keep questioning, keep observing, and keep diving deeper.